Today, we will be talking about the basics of finance and financial markets. What are financial markets? A financial market is a market in which people can trade future claims on funds or goods. Future claims are an agreement between two separate parties about buying or selling an asset with a future date set. These future claims might be loans, where the bank gives money now in return for repayment in the future, stocks, where buying a company stock today gives you a right to a share of future profits, or insurance, where you pay premiums now in return for the right to submit a claim for compensation in the future. When it comes to buyers and sellers, buyers are people who want to spend funds on something valuable now. Sellers let others borrow funds for a price. Some examples of buyers are families buying houses, students taking loans for college, or new business ventures. Some examples of sellers are putting money in savings accounts or mutual funds, buying stocks, or giving loans. These buyers and sellers can either be individuals, corporations, the government, or government organizations. Savings versus investment. Savings is the portion of income that is not immediately spent on consumption of goods and services. Savings are usually kept in banks or bonds. Investment is the spending on productive inputs or other resources for projects with an expectation or chance of receiving increased return of purchase. Some examples of productive inputs might be factories, machinery, or inventories. Both savings and investment help with economic growth and are necessary for the society that we live in today. Savings and borrowers. Savings can be further described as the selling of the right to use your money for a time. Borrowing can be described as buying the right to use someone else's money. Borrowers are individuals who rely on loans or bonds from a financial institution or someone else. When it comes to the functions of a financial system, there are three distinct points. First, serving as an intermediary. The bank connects the borrower to people with spare funds. Second, provides liquidity. The bank makes cash readily accessible when and where you need it. People do not have to keep cash on hand because of ATMs, credit cards, and checks. Your money is accessible and protected by the bank. And lastly, diversifying risk. Banks pool borrowers and lenders together so that one individual does not bear the full burden of a failed investment. Altogether, these functions of the financial system are very important because they allow for economic growth as a whole.